the primary thing is to look at what the investment objective is and then to try and achieve that in the best risk-return way. So diversification is crucial. The structural growth in alternatives has been immense over the last 20 years as people become more accustomed and more familiar with alternatives. The investability of alternatives has driven asset allocators and LPs to be able to invest in asset classes which never existed 20 years ago, and also other LPs and allocators to invest in things which they were uncomfortable investing in 20 years ago. So now you have private equity is almost standard within most people's portfolios. It wasn't 10 to 20 years ago. And now we have renewables, solar, wind, for example. We have timber and forestry, which again wasn't part of anybody's consideration of asset allocation many years ago, but it is now. So we've seen structural growth in alternative asset allocation from still some pension funds in the UK have very low allocations, but there's no question their intention is to move towards allocating more. We're seeing pension funds investing in alternatives of between 20 and 25% exposure now, which is a fair amount. But some are in there, between 5 and 10, so much different, much lower. But the investability, the ability to achieve returns in a risk-adjusted way is what's driving people towards more asset allocation to alternatives. The ability in this zero interest rate world to get yield, which never existed in certain asset classes, or accessibility to certain asset classes, means that people want to try and get that yield by accessing certain asset classes. So all of that in the round has led to, you can see, structural growth in alternatives and asset allocation. There's a lot of evidence that private equity generates superior returns to traditional asset classes. It clearly has a correlation with equities. However, there is a lot of evidence that you pick up superior risk return opportunity from private equity allocation. And that's driven a lot more GPs to come on the market, lots larger funds over the last 10 to 20 years. Within that, you have to do your appraisal considerably. The range of outcomes for different GPs is large. The range of outcomes, particularly in venture capital, if you go for the best GPs or for the worst GPs, is enormous. So you have to do your diligence and work to work out where you want to allocate your capital. But there is no question that as people become more familiar with the investability of the asset class and the comfort that illiquidity allows you to pick up alpha, then the growth in private equity will continue. The question is whether that will be competed away as more competition comes in. The other question is are we generating the private equity returns from good general partner performance or from financial engineering, more leverage, for example, or other ways of creating leveraged returns. But at the core, the best GPs do outperform public markets, and that's what's driving more capital towards them. Increasingly less so. So historically, the lack of liquidity has been a main driver of straining allocations to it. However, the secondary market, the growth in secondary markets, means that the ability to exit has improved enormously over the last 10 years. You're seeing pools of capital in secondaries for all sorts of reasons. One, for purely to pick up investment returns, but two, to overcome J-curves and other asset allocation reasons, and hence that increase in liquidity has meant that it becomes, whilst a consideration in any allocation, it's not in our minds, my mind, it's not a primary allocation, a determinant, and the maturity of the asset class has allowed that to be less of a consideration.